What if the next company to collapse, like Enron or Wirecard, is already hiding the red flags in plain sight? In this video, we're going to pull back the curtain on how companies manipulate their financial statements, and I'll show you how to spot the subtle and not so subtle techniques they use and how to identify material misstatements. Plus, we'll dive into a powerful tool called the M-score and explore how non-GAAP metrics can sometimes be used to mislead investors. Is earnings management the same as earnings manipulation? Some people say it depends on intent, but earnings management is not necessarily always the result of intentional fraud, but nonetheless, if the end result is that it distorts the application of GAAP, then it brings the quality of the earnings in question. One aggressive interpretation of GAAP leads to another until the quality of the financial information is in doubt. And from my own experience over the years, companies may be somewhat discreet or, let's say, under the radar on how they talk about it. It may take the form of a request from corporate of reviewing all accruals and deferrals to determine if the prior interpretations were too conservative. Meaning, let's see if we can reduce or increase any of the amounts within the realm of accounting professional judgment. That move can be interpreted as just due diligence and ensuring consistency in the application of GAAP, but can also lead to picking and choosing by corporate which items are adjusted. So there is a fine line. Our textbook showed a chart titled "Where Do You Draw the Line?" that showed the continuum of ethical financial reporting that at each extreme violates US GAAP. However, it also showed that there was a range from overly conservative to neutral to overly aggressive that was within GAAP. If a company takes an overly aggressive stance on each accounting issue, although within GAAP, it can result in a significant potential financial risk and exposure. Earnings manipulation can take various forms, and there are always some new creative ways companies achieve earnings manipulation. Here's some of them. Income smoothing occurs when companies artificially even out or smooth out their earnings over several reporting periods by shifting revenues and expenses between periods. This makes it appear as though the company's financial performance is stable and predictable when it might be inherently volatile. Wall Street analysts like predictability, and even a small miss can result in quick changes in analysts' ratings and then impact the company's stock price. One recent example of an earnings miss that comes to mind is Royal Caribbean. In Q2 2025, the company beat Wall Street earnings per share estimates of $4.10 by 28 cents, but missed the revenue estimate of analysts of $4.55 billion when it reported $4.54 billion, a miss of about $10 million. The stock price dropped significantly despite the company increasing its annual profit forecast. So it's understandable that companies are skittish about showing anything other than predictable and steady earnings. Nonetheless, this is considered a form of earnings manipulation. In the case of big bath accounting, a company anticipates poor future performance. There are many situations where the company must then accrue for those losses in the current year, even if they're not expected to happen until next year. Examples are future severance pay, a loss on a contract that terminates in the next year. So managers know that it's going to be a bad financial current performance year. In this scenario, the company might intentionally overstate its losses or expenses in the current period, creating a big bath of poor performance. Basically, it's a really bad financial performance year anyways. It doesn't really matter whether it's terrible or really terrible according to these companies. By increasing accruals, meaning being very conservative in the interpretation of these accruals, it allows the company to show significant improvements in future periods, making it look like a strong recovery is happening. Another version of this type of earnings manipulation would be to keep any good news out of the year that is already bad. Some executives might use the language of, I'm keeping this in my back pocket for next year, meaning the favorable financial transaction should be pushed into the next year. No matter which way you turn it, though, it is still earnings manipulation. As part of channel stuffing, companies might push excessive amounts of products onto distributors or customers at the end of a reporting period to recognize higher sales and profits. This can lead to an unsustainable boost in revenue. Auditors look for large sales at year end, followed by credit memos at the beginning of the new year to identify these type of practices. Income shifting occurs when multinational corporations may shift income between different subsidiaries or regions to minimize taxes or regulatory burdens. Timing of expense recognition happens when companies delay recognizing certain expenses or accelerate revenue recognition to make their financial performance appear better than it is. The recent case of First Brands, an auto parts company that filed for bankruptcy with $2 billion unaccounted for, highlights another case of financial manipulation. In this case, the company used its accounts receivable to obtain multiple loans from different sources, but pledged the same accounts receivable accounts. So they might have said, I have $1 million in accounts receivable from AutoZone that aren't due for another 120 days. Can you lend me money against that? It is a common practice. However, in this case, the company appears to have gone to multiple lenders and received loans for the same accounts receivable. The moral of the story is that people are creative and money is a big incentive to defraud others. So don't interpret the above list as a complete list of earnings or financial manipulation. What impacts, beside the obvious that it violates GAAP or SEC regulations or the law, does earnings manipulation have? Let's look at that next. Earnings management misleads investors, creditors, and analysts and other stakeholders who rely on financial statements to make decisions. When financial statements do not accurately represent a company's financial position and performance, stakeholders cannot make informed choices. It erodes trust in financial markets and the broader business community. When investors believe that financial statements can be manipulated, they may be less willing to invest in or lend to companies. Earnings manipulation distorts market efficiency because accurate financial reporting is crucial for market efficiency. Earnings management distorts market prices and can lead to misallocation of resources and investment decisions based on false information. Earnings management can cross legal boundaries and violate securities laws. Companies and individuals engaging in fraudulent earnings management can face legal actions, fines, and imprisonment. While earnings management might provide short-term benefits, it can harm a company in the long run. Once the manipulation is uncovered or when the effects wear off, the company may face serious financial difficulties or a loss of credibility. Auditors need to watch out for these red flags that exist as a result of overly aggressive accounting or downright manipulation of earnings. Our list starts off with growth in market share that seems unbelievable. Sometimes that can still be real, but it should set off a warning light. Frequent acquisition of business or management, strong emphasis on earnings or EPS, reliance on income sources other than the core business should alert stakeholders. And it's definitely a warning light when the company meets targets, but only because they have other income unrelated to core business. That's similar to the next item, one-time sources of income. The next items are mismatches in financial data. When revenue increases, then that change should be apparent in receivables and inventory. So if that is not happening, or there's an unexpected increase in accounts receivable, a slowdown in inventory turnover, or a reduction in reserves, that adds to the warning lights going off, as is the last item of not reserving for possible future losses. One of the tools that stakeholders may use is the M-score calculation. But unless you study accounting, you have likely never come across the M-score, which has been used since the 1990s to identify red flags that might point to earnings manipulation. And that's what the M in M-score stands for, manipulation. The M-score is calculated from 8 ratios on a company's financial statements, all numbers that publicly traded companies report quarterly, and it compares the ratios to earnings statements from a year earlier. There are ways for companies to manipulate all these metrics to appear profitable, even when actual sales aren't improving. Now, of course, there could be legitimate reasons for any of these, but collectively, if these metrics are moving in the wrong direction, it suggests funny business. The emphasis is on suggests, because it does not prove it. The M-score's most famous moment came when it was revealed that 3 years before Enron's collapse, a group of students at Cornell University's business school used Dr. Benesh's model to flag that Enron may be a company manipulating its earnings. Though their report was posted online, it received little attention until after Enron's collapse. The model also flagged the German payment processor Wirecard. Its spectacular collapse after accounting fraud was exposed in 2020 drew comparisons with Enron. On June 17th that year, the firm was valued at $14 billion, and 8 days later, it filed for the equivalent of bankruptcy. Models such as the M-score aren't necessarily smoking guns. They will sometimes flag legitimate businesses, especially with mergers and acquisitions. Strange shifts occur when companies absorb each other. Another factor can be the introduction of new technology or individual companies having a significant market advantage, like, for instance, NVIDIA, which we'll take a look at next. So the M-score is not a foolproof way to identify earnings manipulation, but an unusual M-score would be a reason to look more closely. One of your assignments this week is to enter the financial metrics of a publicly traded company into this model and interpret the results the model calculates for you. To illustrate how to complete it, I've completed the information for NVIDIA and Carnival Inc. Here's the M-score calculation for NVIDIA, and just in case you're wondering, the financial statement numbers are from the Wall Street Journal website, and the amounts are in millions of dollars. The first 6 inputs are from the balance sheet: accounts receivable, current assets, current liabilities, total assets, property, plant, and equipment, or PPE, and long-term debt. You enter these numbers first for the current year and for the prior year in the second numbers column. This is followed by the next 4 inputs from the income statement: sales, depreciation expense, cost of goods sold, and SG&A expenses. Then we enter the cash flow from operations and net income, excluding extraordinary items. Just by glancing at the numbers, you can see that most numbers increase significantly year over year. Sales more than doubled, and so did net income. The M-score of 0.959 minus 0.959 indicates that NVIDIA is a likely earnings manipulator, and it puts the probability at 16.9%. This model highlights several factors that should be researched, from revenue recognition based on the day sales and receivable index, the high sales growth, a declining depreciation rate, and changes in working capital. On the other hand, the reality is that AI has catapulted the sales for many companies in recent years, and we therefore have to take these results with a grain of salt. Nonetheless, it gives the financial statement analyst something to ponder and investigate further. Carnival Corporation, the company that owns the Carnival, Princess, Costa, P&O, Cunard, Holland America, and the Seabourn Cruise Lines, on the other hand, is of course much smaller in terms of every single financial statement measure. The M score of minus 2.850 indicates that Carnival is unlikely to have manipulated its financial earnings. Is it guaranteed that there are no financial improprieties? No, it's not a guarantee, but the estimated probability of 0.002 tells us that it is a remote possibility. In the intro to this video, I mentioned that companies use subtle and not so subtle forms of earnings manipulation. One of these subtle forms are non-GAAP financial metrics. Most companies disclose non-GAAP financial metrics. In fact, over 97% of S&P 500 companies do so, but yet little is known about the objectives of disclosing these numbers, how they're determined, management's intent when disclosing non-GAAP amounts, regulation of these disclosures, and the auditor's responsibilities. This is important because adjusting earnings from GAAP to a non-GAAP measure is subject to earnings management, and it can mislead investors and analysts about the true earnings of a public company. Former SEC Chair Mary Jo White commented that quite often the non-GAAP information, which is really only supposed to supplement GAAP information, becomes the main message the company presents to the stakeholders. Kind of like, don't look at our financials, the real story's over here in these non-GAAP financial metrics. For instance, a company may report non-GAAP net income to present in the company's view the more representative net income by removing one-time items, unusual items, or non-recurring costs. In my experience, unusual items in the financial statements aren't always that unusual. What I mean is every year may bring a different unusual item. Perhaps one year it's a windfall from a settlement, the next year it might be restructuring costs or acquisition-related charges, whereas the following year it could be gains or losses from asset sales. By excluding these one-time items, the company seems to indicate that the following year there won't be any one-time items when it will likely have other one-time items. Item 10E of SEC Regulation SK requires publicly traded companies to disclose and reconcile non-GAAP financial metrics, and why management believes that presentation of non-GAAP financial measures provides useful information to investors. Companies need to ensure that the non-GAAP financial measures are not misleading or prohibited by the rules. Appropriate controls should be considered and established by management, and audit committees must oversee and monitor the use of non-GAAP financial measures and disclosures. The audit committee should ask management to explain the usefulness of non-GAAP financial measures in the company's public disclosures. So when do non-GAAP financials become a clear form of earnings manipulation? Non-GAAP financial metrics are only considered misleading by regulators like the SEC if they exclude normal recurring expenses, are presented inconsistently, or are presented without a clear reconciliation to the most directly comparable GAAP measure. In summary, earnings management involves manipulating financial statements to create a false perception of a company's financial health. This practice is unethical because it undermines trust, distorts market efficiency, and can have serious legal and financial consequences for the company and its stakeholders. It is essential for financial reporting to be transparent, accurate, and reliable to maintain the integrity of financial markets and the broader economy. When earnings manipulation is present, there are likely signs, red flags, and the M-score can be helpful in assessing whether manipulation in the financial statements is occurring. Non-GAAP financial metrics are not inherently considered earnings manipulation if they're true, presented consistently, and don't violate any of the SEC rules. I hope you enjoyed this video and learning about earnings manipulation.